Welcome back to Accounting Made Easy series. This is Waithera Mwangi presenting to you a discussion on to define the term inventory. But before we go to that, I would like first of all to bring in some sample questions so that they can help us in the discussion that we are going to have. Number one, what is the objective of International Accounting Standard number two? Number two, define the term inventory. Number three, state the 5 types of inventories. Number four, using an example, state and explain the fundamental principle of International Accounting Standard number two. Number five, state the disclosure requirements for inventories according to International Accounting Standard number two. And number six, explain the cost of an inventory. And part B, inventory cost does not include the following category of costs. So we shall base our discussion on the questions. So we start with, first of all, the objective of International Accounting Standard number two. The objective is to prescribe the accounting treatment of inventories. We want to define the term inventories. And we are saying these are assets, and not only assets, they are current assets. And we are saying these are assets that, part A, are used or consumed in the production of goods or services. That means they are raw materials or consumables. Part B, they are assets that are in the process of being converted into finished goods. That is, they are work in progress. Part C, they are assets that are held for resale in the ordinary course of business. That means they are finished goods. We have categories or types of inventories. According to the discussion that we have had on the definition, we have come across raw materials, consumables, work in progress, that means products or services in the intermediate stage, finished goods for production, and finished goods bought for resale. We want to look at the fundamental principle of International Accounting Standard number two. We are saying inventory should be valued at the row of cost and net realizable value. An example, inventory that costs 200 and net realizable value is 190, the amount that should be recorded in the account is 190 because 190 is the lower of the two. That is, if you compare 200 and NRV of 190. Then example 2, cost of inventory is 200, realizable value is 240, and the cost to sell is 45. So what should be recorded in the books? What should be recorded in the books according to the fundamental principle? It should be 195. How do we get 195? The cost of the asset is 200. NRV is equals to 240 minus the cost of selling, which is 45. We get 195. So cost of an inventory, we are saying it is all the amounts incurred in bringing the asset into the present condition. That there are three basic components. Number one, the purchase price, including direct taxes, less the trade discount. Number two, we have the conversion cost. The conversion costs include the following: direct labor costs, direct expenses, and factory overheads. And number three, any other costs directly attributable to bringing the inventory into useful state. We have some costs that are not part or that are excluded from the cost of an inventory. Number one, abnormal losses, storage costs, administrative overhead, selling costs, foreign exchange losses, interest rates for deferred settlement terms. So recognition of inventory as an expense. Number one, we are going to apply the matching principle. We are saying the portion that has realized revenue should be matched with the related inventory or cost. We are saying the carrying amount for an inventory should only be recognized as an expense in the period when the revenue is realized from the inventory. Then number two, the amount of any write-down of inventories to net realizable value and other losses of inventories should be recognized as an expense in the period the write-down or loss occurs. Number three, the amount of any restatement of cost of inventories arising from an increase in NRV should be recognized as a reduction in the expense in the period the restatement occurs. And then number 4, some inventories may be allocated to other asset accounts. For example, inventory used as a component of self-constructed property, plant or equipment. So inventories allocated to other assets in this way are recognized as an expense during the usage life of the asset. We want to look at some disclosure requirements for inventories. We are saying one of the disclosure requirements is accounting policy adopted, including the formula, the cost formula used. Then the total carrying amount classified appropriately, the amount of inventories carried as, at NRV, that is net realizable value, the amount of inventories pledged as security for liabilities, and lastly, the amount recognized as an expense or as income during the period in which in respect of inventories written down to the net realizable value, net of restatement of cost, the circumstances or events that led to the reversals, or the write-downs.